Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So on this channel, I often talk about some of the things I look for when purchasing an investment. I look for understanding the business, a good management team, some sort of competitive advantage, and an attractive price. That's sort of my quick and dirty kind of criteria on looking to purchase a particular investment, but I don't really spend a whole lot of time talking about constructing an overall portfolio. And really one of the reasons that I don't spend much time doing it is because I don't often sell investments. I don't often make that many changes to my portfolio in terms of getting rid of investments. I do every now and then if I'm just wrong on a business or if something changes in the story of a particular company. But more often than not, I'm kind of just adding to the portfolio over time, kind of like Warren Buffett's sort of 20-hole punch card analogy, if you've heard me talk about that one before. But in this video, I want to cover sort of two analogies around constructing a portfolio, one from Peter Lynch and one from Mohnish. I think both of them are kind of really important lessons and they're analogies that I just kind of like. So that's the topic for today's video. Again, if you do enjoy it, please hit like and hit subscribe. Love to hear your thoughts on some of these analogies down in the comments below as well. But for now, let's get straight into it. So the first analogy we have is from Peter Lynch, the author of this book, One Up on Wall Street. Peter Lynch is arguably the best fund manager of all time. He has an incredible performance record, around 29% per year, return to investors over around a decade and a half sort of professional investing career at Fidelity Magellan. So Peter Lynch is probably one of the more growthier investors that I follow. He's not so much looking for these deep value investments like someone like a Mohnish Pabrai has sort of done in the past. He's really looking for businesses that he can easily understand, that he can recognize, what their future potential looks like, and then try and get in, relatively early with some of those companies. He was invested in sort of the Dunkin' Donuts of the world, for example, that had long runways for growth, and he was able to own them for a long period of time and capture a lot of the upside from the growth of Dunkin' Donuts. And the analogy from Peter Lynch on sort of constructing a portfolio and making changes to it over time goes a little bit like this. It goes that selling your winners and holding your losers is a little bit like cutting the flowers and watering the weeds. Now, of course, if you're a gardener and you're out there cutting flowers and watering the weeds, you're probably the worst gardener on the planet, and that is the exact opposite of what you want to be doing. And Peter Lynch thinks that that is also how you should apply a certain philosophy to managing a portfolio. He thinks that you should continue to own great businesses and you should basically cut the businesses that aren't performing. Now, notice when I talk about this analogy that I'm often talking about businesses. I'm not talking about stock prices when it comes to making these certain changes in a portfolio. So I think that's an important thing to try and understand, is that Peter Lynch, even though he had an incredible track record of stock price appreciation, it was really driven by business results, and he was certainly willing to hold on to businesses if the stock price went down but the business itself was still doing really, really well. So if we are to apply this analogy to our own portfolios, it really means that if we are able to acquire really high quality businesses that are continuing to perform over a long period of time, we should continue to hold on to them, assuming that they don't get to egregiously high prices. And on the flip side of that, if we buy into businesses that we think are going to be really good, but it turns out that they perform very poorly over a long period of time, then those are sort of the weeds that we should be ripping out of the portfolio. So over time, we build this portfolio full of flowers with hopefully minimal weeds in it. And that is a great recipe for compounding your returns over an extended period of time. And although I'm personally not someone that's perhaps fully converted to this idea of only investing in high quality businesses, at least just yet, I'm still kind of open to the more Ben Graham-y deep value style investments. I can really appreciate that great businesses can do, unexpectedly good things as well in the portfolio. If you own something like a Microsoft or an Amazon or an Apple or whatever business it might be that has a really good, strong track record of growth over a period of time, often these businesses can do quite unexpected things to the upside. If you look at, say, Amazon 5 or 10 years ago when they were a retail business, focusing on e-commerce and really starting to dominate that space, no one really was guessing that they were about to come out with Amazon Web Services and have that as a huge driver of, their profits moving forward. So if you can surround yourself in your portfolio with these really high quality businesses, you leave yourself open for the opportunity for these great businesses to continue to do even better things that you kind of never expected. And often that just doesn't happen with lower quality businesses. If you're buying into some company that is sort of steadily going downhill and the business results just keep getting worse and worse, often those companies are in a position where they're just heavily focused on trying to survive and save themselves in their existing business, and they never really are able to sort of innovate and come out the other side with new revenue streams, new profit centers, and that sort of thing. That is something you really only find in the flowers and the great businesses. So culling the weeds is kind of something that Peter Lynch was obviously very big on. Now, the second portfolio sort of construction analogy I have is from the author of this book, the Dando investor, Mohnish Pabrai. We talk about him all the time on the channel, and I find this quote hilarious, but it goes something like this, and that is that the mistress always looks hotter than the wife, but when you start to look into a bit more detail, the wife is always hotter. Now, that may sound like a really strange analogy to try and apply to investing, but let me explain. Now, basically what Mohnish Pabrai is getting at here is typically as an investor, you will have some sort of existing stock market portfolio with a group of businesses in it. And those businesses are going to be companies that you understand really well. It's, relatively easy to read an annual report or listen to some conference calls or listen to investor presentations or whatever it might be and try to get some sort of initial kind of handle on a company. But you really don't understand a business inside out until you own it for some period of time. That's something that I've experienced. That's something that a lot of investors have talked about all the time, is they don't really understand a business completely until they own it and until they watch the price fluctuations sort of month to month, and until they follow along with a few quarters of investing results as it kind of happens in real time. That's the way that you really learn a business inside out over a period of time. And those businesses over time sort of become like your wife or like your boyfriend or your girlfriend or, whatever sort of floats your boat in that department. And, you know all the good things and you know all of the flaws with that particular business as well. You know that really well. And when a new business sort of comes across your radar, when the mistress starts to show up, sometimes that can initially look really attractive to you. Maybe this is a company in some sort of new exciting industry, or maybe it's in an industry that you do understand and it's had this massive growth up until this point and it seems to just be going on really well. All things tend to look fairly positive when you start looking into some of these companies, I've found. And oftentimes they are not as attractive as they might look on the surface of things. Once you start to dig into them a little bit more, or if you do add them to the portfolio and you track them over a period of time, you start to realize things that you maybe didn't realize initially. And the whole point of what Mohnish Pabrai is trying to say here is that the portfolio that you have currently, the companies that you already own, those are the ones that you understand the most. Those are the ones that you've been through the ups and downs and so on with, and they're the ones where you can make the most rational decisions often. If you're in a high quality business and the price goes down or the price goes up, you're able to have a really good handle on whether that pricing of that company is rational or not, and you can make a purchase or a sale decision from that point. Whereas if you're looking at a new company, sometimes new businesses can take a long period of time to get your head around. Some businesses are really straightforward. If you look again at something like a Coca-Cola, that's a relatively straightforward business. But if you look at something like maybe an Amazon, that is actually a surprisingly complicated business. There's sort of a lot of layers to the onion when it comes to that one. So whenever you're looking at new investment opportunities, I think it's really easy to get overly excited about that company very quickly, and it's easy to try and get away from sort of rational thinking. So take Mohnish Pabrai's advice. The businesses in your current portfolio are the ones that you know the best, and just keep in the back of your mind that often when you see new investments are presented to you, they're sort of like the mistress that sometimes looks hotter than the wife, but in reality, the wife is always hotter. So there are a couple of my favorite sort of portfolio construction analogies from a couple of my favorite investors. Firstly, from Peter Lynch, selling your winners and holding your losers is sort of like cutting the flowers and watering the weeds. makes no sense. And also, the mistress often looks hotter than the wife, but the wife is always hotter. That's another analogy from Mohnish Pabrai. So I do hope you enjoyed the video. Definitely drop your comments down below if you do have any sort of opinions on either of those analogies. Do you think it's a good idea to continue to hold your best performing stocks, so your best performing businesses over a period of time? Do you think that the portfolio that you have now are the businesses that you understand the best? Let me know your thoughts on the whole thing. So if you enjoyed, hit like, hit subscribe, and I will see you in the next one. Cheers.